Here is a number that should have your full attention this morning. Every basis point of the Bank of England's next interest rate decision will ripple directly through your mortgage repayment, your savings return, and the purchasing power of the pound in your pocket. Welcome to your UK financial update for Thursday, the 2nd of July, 2026. The United Kingdom is navigating a pivotal stretch in its post-pandemic economic recovery. After years of battling double-digit inflation, aggressive monetary tightening, and severely squeezed household budgets, today's economic picture is one of cautious stabilization, but the risks remain very much alive. In this video, we are going to break down exactly what is happening in the UK economy right now, what is driving the key changes, and critically, what it all means for you. Over the past 12 to 18 months, the Bank of England has been carefully managing a gradual pivot away from its aggressive rate hiking cycle. After holding the base rate at elevated levels through much of 2024 and into 2025, the Monetary Policy Committee began a measured easing cycle, cutting rates incrementally as inflation showed consistent signs of returning toward the 2% target. Financial markets today are pricing in the direction of the next move carefully, and any signal from policymakers carries immediate consequences for borrowers and investors alike. Gilt yields have been relatively stable in recent sessions, but the bond market remains sensitive to any upside surprise in wage data or services inflation. The pound sterling has been holding at levels that reflect both relative UK economic resilience and the persistent uncertainty surrounding global trade conditions, all factors the bank continues to weigh with considerable caution. The genuine good news is that the inflationary crisis which battered UK households from 2022 onwards has substantially eased. Consumer prices are no longer rising at the alarming rates we saw at the peak. However, the cumulative effect of that inflation absolutely remains. Prices are not falling back to where they were, they are simply rising more slowly. For the average UK household, food bills, energy costs, and transport expenses remain significantly higher than they were 4 or 5 years ago. The Office for National Statistics has consistently demonstrated that lower-income households carry a disproportionate burden from this persistent cost of living pressure. Services inflation, driven largely by wage growth in sectors like hospitality, healthcare, and education, has proven considerably stickier than goods inflation, and it continues to be a key concern for policymakers monitoring the Consumer Prices Index basket month by month. The UK labour market remains one of the most complex components of the current economic picture. Employment levels have stayed relatively robust, with the unemployment rate holding in the low to mid-single digits. However, the headline figures mask some important structural tensions beneath the surface. Real wage growth has improved meaningfully as nominal pay increases have begun to outpace CPI, meaning workers are finally, after several deeply difficult years, seeing their purchasing power begin to recover. But the jobs market is cooling at the edges. Vacancy numbers, which surged dramatically post-pandemic, have now returned closer to historical norms. Redundancies in sectors including financial services, retail, and parts of the public sector are creating pockets of genuine labor market strain. The Resolution Foundation has flagged repeatedly that younger workers and those in zero-hours or gig economy roles are particularly exposed to any further softening in employer demand. Property remains one of the most emotionally charged corners of the UK economy, and rightly so. For millions of homeowners, landlords, and renters alike, what happens in the housing market directly shapes their daily financial security. Today, the UK housing market is in a state of cautious recovery following the sharp correction triggered by the rate hiking cycle. Transaction volumes remain below their 2021 and 2022 peaks, and first-time buyers continue to face significant affordability barriers, particularly in London and the South East, where average house prices relative to average incomes remain at near-record levels. However, prices in many regions have found a floor, and the prospect of further interest rate reductions has rekindled some buyer confidence. The private rental sector remains under severe pressure, with rents in major cities at record levels relative to incomes, a crisis that political debate has thus far failed to meaningfully resolve. The Ftse 100 continues to be shaped by a combination of global risk appetite, commodity price movements, and the pound's performance against the dollar and the euro. London's blue chip index is heavily weighted toward global sectors, energy, mining, banking, and consumer staples, which means it does not always faithfully reflect the domestic UK economic picture. For investors seeking a cleaner read on UK-specific sentiment, the mid-cap Ftse 250 is often the more informative barometer, as it contains a higher proportion of domestically focused businesses. On the bond side, UK gilt yields have been a central focus for pension funds and institutional investors, particularly after the extraordinary volatility witnessed in the autumn of 2022. Stability in gilt markets has been essential to restoring institutional confidence in UK assets, and that relative calm has broadly held through 2026 so far, a fact that should not be taken for granted. Government finances remain a central pressure point in the UK economic story. Public debt as a percentage of GDP is at historically elevated levels, reflecting the enormous fiscal interventions of the pandemic era and the subsequent energy support schemes that followed. The current government is operating within tight self-imposed fiscal rules, balancing the need to protect and rebuild public services against the imperative to demonstrate debt sustainability to the bond markets. Tax receipts have been supported by strong nominal wage growth, fiscal drag, the phenomenon where rising incomes push more earners into higher tax bands without any formal rate increase, has generated significant additional revenue for HM Treasury. Capital investment plans in infrastructure, clean energy transition, and skills training remain a point of active debate between short-term fiscal constraint on one side and long-term growth requirements on the other. So what does all of this mean for the person on the street today? For mortgage holders on variable rates, or those coming off fixed deals, the direction of Bank of England policy is the single biggest financial question of the moment. Any further rate cut would ease monthly repayments and provide genuine breathing room. For savers, the picture is more nuanced. Rate cuts mean lower returns on cash savings, which strengthens the case for stocks and shares ISAs and longer-term investment vehicles. For renters, and approximately 9 million households in the UK now rent privately, the cost burden remains acute with little immediate relief visible on the horizon. Small and medium business owners are watching credit conditions carefully, as affordable access to finance directly affects hiring decisions and expansion plans. Today is a day to review your financial position with fresh eyes. Looking ahead from today, Thursday the 2nd of July, 2026, the UK economy is on a trajectory of slow but credible recovery. The difficult work of bringing inflation under control has largely been accomplished. The question now is whether that hard-won credibility can be converted into consistent, sustainable economic growth. The International Monetary Fund has in recent forecasts projected modest positive GDP growth for the UK, not spectacular by historical standards, but meaningful given the considerable headwinds of the past 4 years. The risks remain very real: geopolitical instability, any resurgence in global energy prices, or a sharper-than-expected slowdown in the United States or the Eurozone could all disrupt the recovery. But for the first time in several years, the direction of travel is broadly positive. The key takeaway for viewers today: stay informed, stay adaptable, and do not make major financial decisions based on short-term market noise. The fundamentals are stabilizing, but this journey is not yet over.